Good morning. These are the things that matter most in the U.S. market today. Nasdaq futures are leading as Amazon revives the AI trade. Apple is pulling the other way after a weaker outlook. Cooler inflation data is helping the soft landing story. Oil and energy earnings still test margins. And the underappreciated story is that internet traffic itself is becoming an earnings risk. The central question for private investors is simple. Can Wall Street trust the AI rally if the market is now separating cloud-proof from consumer hardware pressure and traffic risk? Start with Amazon, Apple, and the AI split. Reuters reported that Nasdaq 100 futures led U.S. futures higher as Amazon's surge offset Apple's decline. Google News and Barron's results pointed to Amazon rising despite a large AI capex increase because AWS growth helped calm fears about spending. Apple moved the other way after reports of a weaker forecast and supply chain pressure. The market is not voting on whether AI matters. It is voting on which companies can connect AI spending to visible demand, cloud revenue, and operating leverage. The cleaner side is Amazon's AWS proof, Microsoft-style cloud monetization and chip chain demand, where spending has a revenue bridge. Pressure sits with Apple if supply constraints and slower AI product proof dominate. Plus any high multiple platform where capital expenditure rises faster than confidence. For private investors, the practical takeaway is this. A megacap rally is stronger when more than one company can prove the AI story, but it is weaker when the tape becomes Amazon versus Apple. Second, the macro backdrop is helping, but it is not a free pass. Google News results showed futures rising after cooler June PCE inflation data and solid GDP. That combination is useful because it supports the idea of resilient growth without an immediate inflation scare. But the Federal Reserve has only just held rates steady, and the market still has to process labor data, yields, and whether inflation relief lasts. Good macro data can support risk assets, but it can also raise the bar. If the economy is fine, expensive stocks still need earnings proof. Potential beneficiaries are quality growth, selected banks, and profitable cyclicals if the market reads the data as soft landing rather than renewed inflation. Pressure is more visible in long-duration software, homebuilders, and leveraged companies if yields refuse to fall. For private investors, the useful filter is to separate a healthier economy from a valuation holiday. Lower inflation helps, but it does not remove the need for margins and cash flow. Third, oil and energy still matter for the U.S. tape. Barron's flagged Chevron earnings as a test for the oil giant's next growth engine, while broader market coverage kept oil and inflation sensitivity in view. This is not just an energy sector story. Energy profits can support Exxon, Chevron, and service companies, while higher fuel and input costs can pressure airlines, transports, and consumer margins. If oil strengthens while the Fed is cautious, it becomes a cross-market tax test. Winners are integrated energy producers, selected services, and cash-generative firms with pricing power. Pressure sits with airlines, transports, and consumer-facing margins if fuel costs rise faster than demand. In plain English, the takeaway is this. Oil can help one part of the index and still make the rest of the market harder to trust. The underappreciated story is internet traffic risk. Barron's flagged Reddit falling even after an earnings beat because investors worried about a search traffic trap. That matters beyond one stock. If AI search, changing distribution and platform algorithms alter where users come from, then digital platforms can report good current numbers while the market questions future acquisition costs and audience durability. This is a different kind of AI risk, not chip supply or capex, but whether the internet's traffic map is changing underneath the business model. The cleaner side is platforms with direct user habits, subscriptions, first-party data, and advertising demand they can defend. Pressure sits with companies that depend too heavily on search referrals, viral traffic, or one distribution channel. For private investors, the takeaway is that AI can create winners in infrastructure and still create hidden pressure in attention businesses. The confirmation has to come from user growth, engagement, and ad pricing, not just headline earnings beats. Here is the stock-led watch list. Amazon, Microsoft, and NVIDIA. Does cloud and chip demand confirm the AI rally beyond one earnings day? Apple, Tesla, and high multiple software. Does the market punish weaker product proof or rate sensitivity? Exxon, Chevron, and United Airlines. Does oil become leadership for energy or a tax on travel and margins? Reddit, Alphabet and Meta, does traffic risk stay isolated or become a broader platform warning? Market bias, selective, AI-led, and proof-driven. The market can reward strong earnings, but today's tape is not a blank check for every growth story. The mistake to avoid is treating a futures rally as proof that all risk has cleared. A better filter is confirmation. Which companies can turn AI, inflation relief, and demand into cash flow, and which ones only share the theme? That is the U.S. Morning Market Brief. We will be back tomorrow at the same time with everything that matters. Research context only. This briefing is not investment advice.